Tony, the debate is certainly moving markets. It is interesting, although I would like to question all these men and say, how do you know if something's overvalued when we don't know what the economy is going to look like in 6 to 9 months? What do you think?
Well, that's a great point. And by the way, with all due respect for Bill Miller, the consensus earnings is coming down quickly. And consensus is still 17 times earnings predicated on $165 consensus earnings. We're probably looking at $125. So when you think about where multiples are today, they're much higher than Bill Miller, I think, indicated. So, but to your question, Brian, we have to understand what's going on in the real economy. And we're expecting to see for the second quarter GDP down 40%, 40. And so when you think about recovery in the context of reopening different states, even if we had a great outcome and we recovered half of the lost GDP, we're still looking at a level that's 20% below where we were last year for the rest of this year. On top of that, best case, we don't expect to see a vaccine until the middle of next year. So we need to see significant improvement in the real economy that's not probably realistic. And then on top of all that, we need to see a fiscal response that is going to extend what we've already seen. We could need another $5 trillion in cash transfers from the government to consumers and small businesses in order to keep the economy afloat. So all of that is highly uncertain. Whether we get that policy response, we're already seeing pushback from Republicans. And on top of that, going back to the real economy, how much are we really going to recover? We saw your segment on Starbucks earlier. To think that Starbucks will recover half its lost revenue, that's probably optimistic in and of itself. All that comes together to suggest the stocks are overvalued.
Yeah, and I hate saying this with a lot of people starting their day with us, but we also have to price in, I would imagine, if you own equities, the very real possibility that a vaccine will not be created. And if it's not, it may not be created for years to come. I mean, I hate saying that. We hope we're wrong, but when you look to investing, I would imagine you have to put that scenario and the possibility of sort of rolling re-shutdowns, if you will, into your equity valuation analysis. Do you not?
Yeah, if you're going to do a broadly distributed scenario-weighted analysis, you probably do have to do that. I mean, we're assuming that we are going to get a vaccine signed, sealed, and delivered by the middle of next year, and we're still underweight equities, and we think that they've run significantly ahead of where they should be because the market is discounting a much stronger recovery in the real economy this year and a policy response that's going to continue to provide the support that we've already seen. Remember, 40% down in GDP in the second quarter, that's taking into account all the cash transfers that have happened from the federal government to small businesses and the unemployed. If we don't get that,
so quickly, Tony, we're running out of time on the show. I'm sorry to jump in on you like this. You said underweight equity. So very quickly, do we sell and raise cash, or just not any new buying? Quickly,
we would sell and raise cash, and we would make sure that to the extent we're in equities, we have a bias towards the new economy, tech sector companies, and away from value because there's convexity in those kinds of investments right now. They're doing well in both falling markets and in rising markets.